You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, welcome back to Infinite Banking Mastery. I'm going to start today with a question I get pretty often, and that's, how many policies should I have? And right behind it is the question that's really underneath it. Is it better to have just one big policy, or should I have several? The short answer is, well, there is no magic number. But if you actually do a good job of taking over the banking function in your life, you are very likely going to end up with more than one policy. Not because someone told you to, because the system itself is going to require it. We will look at why. However, before we get into the why, I want to kill a myth right out of the gate. A lot of people, especially newer to this, think the goal is to find the one perfect policy. Get it sized right, fund it right, and just be done. One contract, one decision, set it and forget it. But here's the thing. Infinite banking isn't a product that you buy once. It's a function that you build. It's the banking function in your life. And a function that's actually working is going to grow. It's going to need more capacity over time. So instead of asking, how many policies should I have? I want you asking a different question. Do I have enough capacity to capture and recapture every dollar flowing through my life? That's the real question. And the answer to that question is what determines your policy count, not some number that you pick out in advance. So let's walk through the actual reasons why this happens. Reason number one, you can't overfund a policy without meching it at some point. Reason number one is purely mechanical. It's the IRS that's the problem. Every whole life policy has a ceiling of how much premium you can pour into it relative to its death benefit before it crosses a line and becomes what's called a modified endowment contract, a MEC. Once that happens, you lose the tax treatment, and the tax treatment is one of the major wins with this strategy. I'm sure you would agree. It becomes possible for withdrawals to be taxed and even loans to be taxed. So it makes some pretty big changes to the policy if you end up meching it. Every policy you own has a capacity, a ceiling, and once you hit that ceiling, you have exactly two choices. You can stop capitalizing your system, or you can open another policy. I would never tell you to stop capitalizing your system. So when a policy maxes out, the answer isn't, well, I guess I'm done growing. The answer is you open another one. So long as you're able to, that is, as an insurable, or you can insure a family member or other person you have an insurable interest in. That is how the process of IBC is designed to work as you scale. And that's why I often suggest adding a term life policy at the same time you are underwriting for your whole life policy. Since you're already in underwriting, we can prepare for the growth of your future system by also acquiring a term policy at the same time. Then when you're ready to grow, you can do so easily with no additional health or financial underwriting. Okay, so reason number two, taking over the banking function. When you start actually using this system, financing cars, paying off debt, funding business equipment, doing real estate deals, whatever it is, you're no longer sending your interest payments to a bank or a finance company and watching that money disappear from your life forever. You're paying your policy back, and therefore principal and interest is flowing back into your own system. And that money has to go somewhere. And this is where people sometimes get confused because it's not a one-time event. It's more like a loop. You take a policy loan, you use the capital, you pay it back with interest. And now you've got returning capital needing a home. If your original policy still has room, great, it goes back in. But if that policy is already near its capacity, then returning money needs a new bucket. If you can't fit the funds as a loan repayment into your existing policy or as additional premium dollars, you will need a new policy. And this is the moment you go from I have a policy to I have a system. Because once you're actually running your own banking system, recaptured interest becomes a recurring event, not a one-time thing. And a recurring event needs ongoing capacity. Reason number 3, you have an increase in income. This one's simple, but it sneaks up on people. You design a policy based on what you can capitalize at that time, your income, your cash flow, what makes sense for your life right then at that moment. But income doesn't always stay flat. You'll get a raise eventually, hopefully. Your business has a great year. You pick up a new revenue stream, maybe. You have cash flow coming from your rental properties. Your old policy will be sized for your old income. It wasn't necessarily designed with that extra capacity in mind, which means it probably doesn't have room to absorb the extra income without, mecking. So new income, especially a large jump, very often means it's time to open another policy, sized for where you are now or at that current time. Not where you were when you started, but where you are now. Now, if you know you will be having an increase in income or cash flow within the next 12 months of opening your policy, it's possible to factor that in from day one. However, if you aren't certain or not expecting an influx of cash, then the policy should be designed based on what's possible and where you are now. On to reason number 4, insuring other family members. Now let's talk about something a lot of people don't think about until later, insuring people other than yourself, your spouse, your kids, even your grandkids. Each one of them is a potential vehicle for your family's banking system. And there's a strategic reason to doing this early: insurability and cost. The younger and healthier you are, the more likely that you will receive a great health rating, which keeps the cost of the insurance down. A policy on a child today locks in decades at the lowest cost that they'll ever see, because the younger you are, the less it costs, always. Business owners may want more than one policy. If you run a business, you may want a policy for your personal banking and a completely different one tied to the business itself. Your business can take loans from your personal policy as well. You just may have other reasons to have a secondary policy for business purposes, whether that's key person coverage, funding for a buy-sell agreement, or simply capitalizing the business's own banking function. So how many policies isn't just a personal capacity question anymore. It may become a family and business question too. Reason number 5, building your pool of wealth. Here's the one that ties everything together. Every policy you add isn't just another insurance contract, it's another reservoir, another pool of cash value, growing on its own uninterrupted compounded curve that you can access to finance whatever's next: a property, a business opportunity, or an investment. So picture it this way. It's not that you're managing 5 or 6 separate disconnected accounts. You're managing one growing system that happens to have multiple buckets, multiple access points, all working together. The more buckets you have, the more cash you are able to flow through your system, and the more you are able to capture the earning power of as many dollars as possible. So let's bring this back around. If you're sitting there thinking, okay, but seriously, am I doing this wrong if I've got 4 policies or 7? Just remember, there is no finish line. There is no number you're supposed to hit. Your policy count is simply a reflection of how much of your own cash flow you've been able to capture and how much capacity you've built to hold it. Every so often, I talk to someone who is hesitant to start a second policy. Like maybe that means they did something wrong with the first one, like they're failing somehow. But it's the opposite. Actually, needing a second policy means your first one worked out exactly as designed. It filled up because you used it, and that's progress. So the real point to all of this is to have control over your capital. It's not about chasing a policy count or winning with the most contracts. It's about control. The more cash value you have access to, whether that's sitting in one policy or spread across 8, the more uninterrupted compounding you've got working for you, and the more capital you personally control to finance your life on your own terms. One policy isn't wrong, it's just usually where you start, not where you finish. If you're actually serious about running your own banking function long term, you are likely to end up with more than one contract. It's that simple. So as a quick recap, the 5 reasons your system naturally grows beyond one policy are: you can't overfund without mecking at some point. You need somewhere to put recaptured loan repayments when you run out of space in that policy number 1. Income growth creates new capacity. You may want coverage on other family members or your business or other business partners. And every new policy adds another bucket to your overall pool of wealth. If you start off only able to do $10,000 a year in premium to build your banking system, and that's all you're ever able to do, well, that's great. I'm happy for you. It's certainly better than nothing. But what if, as your income increases, you take over debts to outside banks, take over the financing needs in your life, and you decide to use these advantages to grow your banking system? You may end up with like 5 policies being funded at $10,000 each. You're going to be able to do a lot more with that growing pool of capital and have access to much more cash value during your retirement years. Just keep in mind that there's no target number, no finish line, just growth in proportion to how seriously you're running your own banking system. Now, if you're feeling ready to get started with policy number 1 and would like to work together, as always, feel free to reach out. You can reach me at Valerie@alphaomegawealth.com. I'll catch you on the next episode. Have a great week.
This is thepodcastfactory.com.